Floor show and speak to our traders today. Revere Securities Portfolio Manager Scott Foreman and Great Hill Capital Chairman Thomas Hayes. Gentlemen, thank you both for being here. Scott, let me begin with you. We're going to get the Fed decision tomorrow. Are you one of those in the camp that expects a rate hike of 75 basis points?
Actually, I think the market now has counted that in. I think after what we've seen over the past several days, I think it's already figured in. And the thing that is concerning is if we only come in with a 50 basis point hike, will the market then say the Fed hasn't done enough and sell off even further? That's a possibility that we have to watch out for.
Absolutely. Tom, same question to you. Firstly, what do you expect and how are the markets going to react? Apparently, they're expecting a 75 basis point hike.
Yeah, well, they wouldn't have leaked the story to the Wall Street Journal, Ashley, if they didn't intend to do it. So I do think that's coming. I do think that the markets will show a sign of relief. The market is really anxious about inflation right now. And if we look back to 1994, that was the last time that a 75 basis point hike happened. That was November of 1995. The market had been down all year ahead of that hike. It finished the year positive, plus 1.3%. And then the next 5 years averaged 28.7% per year on the S&P 500. Now, whether they can do a soft landing this time or not remains to be seen, but that's what happened the last time.
Let me follow up with you, Tom. So we have this situation where the Fed apparently, by many accounts, is still behind the curve, trying to catch up. But have we reached peak inflation? And with regard to the markets, let me come back to that very quickly. Have we seen bottom? It's a question that many analysts are asked daily. And I know it's very difficult to answer that question, but have we at least, can we see the bottom from here?
Yeah, I think you can certainly see it on a selective basis, Ashley. There are certain companies that if you can take a 1 to 2 year view, you're buying them at bargain basement prices. If you look at forward earnings for the S&P 500, while the pessimism continues to rise, so do earnings estimates. Right now at 251 for 2023 on the S&P 500, that implies 15 times next year's earnings. The last 5 years averaged 18.6 times, which included the last tightening cycle. So as far as inflation goes, the PPI numbers were somewhat encouraging simply because April was the peak for PPI, and that tends to lead CPI. So first you see it in the wholesale prices, then you see it in the consumers. So, you know, we're hopeful, but they're not great numbers for sure.
Scott, let me get back to you. Tom mentioned that word, you know, that expression, soft landing. Where do you think this is? JP Morgan said, yeah, I can see getting out of this with a soft landing as the Fed hits the brakes pretty hard. Morgan Stanley, though, says there's a 50% chance of a recession. Where do you stand?
I think that basically we're in a very, very precarious situation. Oil prices are the driving force here. You know, as long as gasoline keeps going up, the Fed's going to remain behind the curve. Consumers are feeling it, and that's going to cause them to, they're cutting back already on what they're buying, and that is leading to an increasing chance that we're going to see a recession. Now, I think what you could see is a combination between a recession and a sort of a soft landing where we don't go too deep into recession if they can get these prices under control in the very near future.
Well, with that said, and in this environment, Tom, let me come back to you. What do you like? I mean, you know, what are some of your picks in this very volatile, uncertain environment?
Well, actually, they're unconventional picks because if you look at the developed world, Europe and the United States are aggressively tightening right now. But there are two large economies in the world that are aggressively easing and stimulating, Japan and China. We like three plays to take advantage of China's easing policy coming out of the lockdown. You've seen Alibaba now up 42% off of its March lows once the government pivoted from their crackdown and they started with the reopening. The stock started to go up. There are rumors, unconfirmed by Reuters, that potentially the Ant Financial IPO could go off sometime this year. Alibaba shareholders own a third of that. And you're expected to get 20% earnings growth next year. So the Chinese government is trying to promote consumption coming out of the lockdowns to recover their economy. We also like Taiwan Semiconductor. They've got 50% of the auto chip market. Their production's up 60% year on year, trading at 13.5 times earnings, with 2 years of backlog with the new car manufacturers all over the world needing to build those inventories. And finally is Nike, gets 20% of their revenue out of China. It's their most profitable market, and the overhang on the stock has been related to China, and now they're coming out of lockdown. They're expected to grow earnings 22.6% next year.
Unconventional, but very interesting. Tom, Scott, very quickly, who do you like?
So first, we like Tyson Foods because we believe people really need to be focusing on some defensive type stocks, and people have to eat regardless of what happens with the economy. So, you know, we're looking at companies like that. Also, we're in the energy space. We're looking at Phillips 66 right now because, again, as these prices go up, people still have to fuel their cars. These profit margins are going to go up for the energy companies. And finally, we had one that we added to our list looking at as we were coming into this interview today, C.H. Robinson, CHRW. The fact is that especially on the back of the FedEx move today, we think that transportation is going to improve, the supply chain is going to improve, and therefore this is a company that we believe will benefit from that.
Terrific stuff, both of you. Thank you so much for great insight and information this afternoon. Scott and Tom, thank you very much for being here.
Thanks, Ashley.
All right, we have a thank you.